And to break this down further, let's bring in Peter Schiff, CEO of Euro Pacific Capital. So, Peter, last time yields were this low, we saw the Fed step in with an insurance-type cuts in 2019. So do you think the rhetoric will still be the same this time around, or will they actually commit to cutting all the way down to zero to avert pandemic fears and possibly even going negative?
Well, whether they commit to moving to zero or not, that's exactly where they're going. And in fact, the bond market is telegraphing right now that we're going to have several more rate cuts, I think, between now and the end of the year. And I think the bond market is right. But it's not that this is the appropriate policy. The Fed should not be cutting interest rates, but that's what they're going to do because that's the only thing they can do. But it's not going to cure the coronavirus or the economy. It's simply going to make the U.S. economy sicker.
So, we're watching the virus spread outside of China now to countries that are not as strict with quarantines, checkpoints, kind of these all-city lockdowns, even though Italy may have had a big effect on the markets because of the fact that their response has been to now institute a lot of these lockdowns, if you will. I mean, about 50,000 people, roughly, are under some kind of quarantine in Italy, not even close to the 60 million we're talking about in China. But for a European country to take those steps, is that causing some of these fears to rise in terms of the spread of the virus?
Well, certainly. I mean, the coronavirus fears are out there. It's just one more thing to worry about. Look, the U.S. economy, for example, is a gigantic bubble. And maybe the coronavirus is going to be the pin. I mean, I have no idea, but if it wasn't this, it would be something else. But there are some much deeper problems than the coronavirus. The markets in general are very overvalued. You have a lot of leverage in the system. If we had a healthier economy, we could better withstand the coronavirus, whatever it turns out to be. But the bigger problem is the Fed's cure is actually worse than this disease, because if the coronavirus actually becomes an even bigger deal, the real threat is that it bottles up production, that fewer people are on the job, so fewer goods get produced. Companies can't get the supplies that they need, so you bottle up the supply chains, and we get a shortage of stuff. And the correct monetary policy is to drain liquidity to match the reduction in supply. But if instead the Fed and other central banks pour in even more liquidity and create increased demand for a diminishing supply of goods, then you really get a big increase in consumer prices, and that worsens the downturn. You get, worst case, a stagflation.
Now, U.S. Treasury Secretary Mnuchin said that apparently he does not expect the coronavirus to have any material impact on phase one of the China-U.S. trade deal or even the economy. Just like he said that the tariffs during the trade war were also paid by China and not the consumers. But whatever, given the slowdown, how is China supposed to deliver on its $200 billion worth of purchase commitments when even previously, before this entire coronavirus even started, analysts were skeptical of it?
Yeah, well, first of all, Mnuchin is going to put a positive spin on any news. And in the first place, the Chinese were not going to live up to those commitments anyway. They weren't even real commitments. And there's no way they know how much agriculture, for example, the Chinese are going to buy, let alone how much they're going to buy from the United States. So the whole thing was a smokescreen to cover up the fact that we really didn't have a deal. But now the coronavirus actually gives the Chinese a better excuse as to why they're not living up to a deal that they weren't going to live up to anyway.
And on trade, we saw the U.S. dollar is continuing to strengthen at this point, shooting to a 3-year high versus the euro. We've also seen President Trump accuse other countries of devaluing their currencies to aid exports. When do you think this is going to start becoming a problem for U.S. corporates and U.S. exports? And also, in light of what's happening with the dollar right now, we're also seeing gold going way up. I know you're big on gold. How do you think that shakes out?
Well, first of all, I don't think other central banks are deliberately weakening their currencies. I mean, they're pursuing the same type of inflationary monetary policies that we are. But what's happening is traders, speculators are buying into the dollar because they falsely believe it's a safe haven. It's not. They should be buying gold, and of course other people are. Gold hit all-time record highs today in the euro, in the yen, and Swiss franc, Aussie dollar, Canadian dollar. A lot of countries, currencies, Indian rupee. You're seeing prices for gold that where gold is never traded at. In the U.S., we're near a 7-year high, but we're getting close to an all-time high in dollars too. So all currencies are weakening right now. It's just that the dollar is weakening more slowly than a lot of other currencies. But that is going to change because people who are piling into the dollar because they think it's a safe haven are eventually going to pile out, and the dollar is going to start to fall. And in fact, it didn't even hold on to most of its gains today. It had some early morning gains, but by the end of the day, it had lost most of those gains.
Peter Schiff, CEO at Euro Pacific Capital, thank you so much.